Thank you, Adelila. Good day, everybody. I'm Junaid Bray. I'm one of the portfolio managers at Laurium Capital, and we are proud to be partners with Curate, and we manage the Curate Momentum Equity Fund. So the theme of today's presentation, we're just going to take you through some of the ideas of where we're seeing opportunity in the market, and particularly with the theme of electrification, and how we've positioned the fund to benefit from some of those ideas and that theme going forward. So to give you a brief overview and highlight of the fund, the Curate Momentum Equity Fund, it's predominantly a South African equity fund, but it does include some global ideas, and really it's complemented by some of our best ideas and high conviction global ideas. And what that also does is it diversifies the portfolio, so it allows us to invest in some of the sectors and themes that we don't ordinarily get direct access to on the JSE, the likes of pharma, tech, etc. And it just really allows us to implement some of those ideas in the fund. So if I look at just a brief background on Laurium Capital and who we are, we've been around for about 17 years, started in 2008, initially as a hedge fund. And we've diversified the business, adding our skill set and track records across South African non-only funds, an African equity capability, as well as a global equity capability. And I think what makes us a bit unique is that we've got one integrated research and investment team across all these different funds. And we even though we've grown to about 75 billion rand of assets under management, we place a high emphasis on always staying with the boutique mindset and entrepreneurial mindset that made us successful at the beginning. And we still keep that the boutique agility in the style that we manage the firm as well as we manage the funds. And the firm is owner managed, so we don't have any external shareholders. The shareholders are all, other than a trust. The ownership of the firm is all owned by staff. So if I look at the key portfolio managers on this fund, so the two co-founders of the firm, Mari Winkler and Gavin Forberg, who started the firm back in 2008, around the time of the global financial crisis. The other portfolio managers are myself and Mike Lawrenson, and then Rob Ullerman, who's our global portfolio manager. We work very closely with Rob to get the best of his global ideas into the fund. And we're supported by a team of about 15 investment professionals, analysts, as well as our traders and quants guys. Looking at the performance of the fund, so the fund doesn't have that long a track record, but I think year to date, the fund is doing reasonably well. We're up about just under 25% year to date. And if we think about our benchmark, the way we think about it, the fund is roughly 2/3 South African equity, 1/3 global equity. And the blend of the Cap, Swix, and ACWI in those proportions is up about 22.7%. So we're just shy of about 2% of alpha year to date. And then against the peer group, which is South African equity funds with an offshore component, we're well ahead of the peer group as well year to date. And you can see that the local market has actually been very strong. The local market's done about 31%. And in Rand terms, the MSCI all country world index is up about 8.2%. So if I look at where that performance has come from, we've had a reasonable exposure to gold and platinum, and some of those names, predominantly our exposure to Anglo Gold, which have been our preferred pick. That's contributed very nicely to performance, as well as Impala and Northam. And then Naspers and Process, also a high conviction name in the fund. That's contributed to performance. And then some of our offshore names, the likes of Quanta, Broadcom, GE Vernova, and Arca Continental, as well as JP Morgan Chase, all contributing positively. What's detracted from performance, really a lot of the gold and platinum names, which have also been very strong, which we haven't had exposure to, detracted to performance on a relative basis. And I'll touch a bit more on some of those names going forward. So if we just look at the SA equity market, that 31% that we've had this year to date to the end of September, it's been very strong. But it has been a very narrow market. If we look at where that performance has come from, so what we're looking at on the slide is really the contributors to the 31%. So you can see gold up until the end of September has contributed about 14% of that 31%. PGM's another 6%. So nearly 20%, over 20% of the 31 comes from gold and platinum. And then last percent process another 6%. And then the telco space has actually been very strong this year, another 2.5%. And then there's a tails off quite quickly after that. But you can see how narrow the performance of the market has been. So gold's been strong, and we know, of course, the gold price has been. We all know the gold price has been very strong, crossing 4,000 and pulling back from the, and then PGM prices as well. That's platinum group metals, mainly platinum, palladium, and rhodium, and then a tail of smaller metals, also being very strong. So what's driven that? I mean, we know that, in the heightened geopolitical uncertain environment of 24 months, that's given some tailwinds to the gold price. And I think a big change in the market was, so if we look at what's driven the gold price, and I think a key game changer to the backdrop of what's driven the gold price, I think after Russia invaded Ukraine, and I think, reserves were sort of weaponized, central banks, especially emerging market central banks, started diversifying away from the dollar and started adding gold. So you can see that this is the net quantity of purchases by global central banks. You can see that in the last 3 years, how that spiked and how high that is relative to history. And it has pulled back a bit this year, given the much higher gold price that we have at the moment. But it's still relatively elevated, and we don't expect that to change. So what we're seeing is really just that central banks diversifying away from the gold price. And if you look at the next slide, just really shows you the percentage of holdings that's foreign central banks hold in gold. You can see that's been increasing, while the percent held in dollars has been decreasing as central banks diversify away. Then another leg that's been driving is, of course, investment flows. Now there's a mix between retail investors as well as institutional investors. That's also been picking up. From an institutional side, you found that normal 60-40 equity bond portfolios haven't really been working. The bond component hasn't been, offsetting, as historically you get the negative correlation, hasn't been working that well. And of course, the concerns about foreign debt levels. So institutional investors have been increasing their holdings in gold, as well as retail investors. So that's last leg is also in the last 2-3 years. You can see that the holdings from ETFs have picked up, and that's reflective of investment inflows. So that's also taken the gold price higher. So what does this all mean for South Africa? So we obviously know that, now nearly a quarter of our SA equity market is made up of gold and precious metals companies, platinum companies. But beyond the market, from an economic impact perspective, if the prices stay high, and what I'm really showing you here is the terms of trade. So when the terms of trade move positively, I think it does create, there's a possible positive benefit from economic perspective, both from a GDP addition perspective, when you're looking at your exports less imports. So if I just look at a proxy for the gold and platinum less oil, because gold and platinum are nearly 20% of our exports still, despite South Africa reducing much less gold than we did decades ago. It's still combined about nearly 20%. And then oil is one of our biggest, oil and oil related products, one of our biggest imports, and oil prices have been low. So the net result is a very positive proxy for where our terms of trade are headed. So obviously you get the terms of trade data with a lag. You can see that the prices stay where they are. That should move quite positively going forward. And that's got multiple ripple effects for the economy. You get the mining companies earning higher earnings. So that means higher royalties and tax receipts. They also tend to pay some extra bonuses to the employees. So around mining towns, those employees, the spend does tend to pick up. And we have seen that correlation historically. Of course, there's the lag of normally 9 months plus. So we're still relatively early into this, and we haven't really seen that benefit come through yet. But we do expect that to start coming through in the next couple of months, next probably 12 months or so. So overall, the backdrop that creates for South African equities, I think you've got improving terms of trade and helping to support consumer spending. We've also got lower interest rates. We're still expecting possibly another 1 or 2 rate cuts coming through, and inflation's been low. So that's supportive of real disposable incomes. So we expect some of that to come through. Then we've the GNU, we know that, it's not been without its wobbles and issues, but overall we are seeing reforms move in the right direction. Granted, it hasn't been as strong as we would have liked it to have been, or as quick as we would have liked to have been. But we are seeing, for example, we're not really talking about load shedding anymore. I think that's been largely resolved. The next leg is logistics, and we're seeing a lot of bids being put out for private sector participation in the rail networks, both from a passenger perspective as well as from logistics for goods at the ports as well. So I think that's going to take a while to come through, but I think in the next 3 to 5 years, as you get the construction spend for that, and eventually the benefits of improved rail networks, I think that's usually positive for our economy off a very low base. And then I think overall the trend of the dollar weakening. Look, we're not out here to call currencies, but it does seem that that the dollar could continue to weaken, and that's normally supportive for emerging markets like ourselves. We get higher commodity prices, as well as diversification away from dollar assets. So we're well placed to benefit from that, especially given where our valuations are. They're very cheap. So if we look at what's happened more recently in our local market, we've seen that our bond yields have actually strengthened quite a lot. Now, we know that the new Reserve Bank target of about 3% inflation, that's been very well taken by and received by the market. So we've seen our bond yields rally, and in fact, it's gone closer to 9%. And that's sort of the risk-free rate in our market, our 10-year bond yield. But this time around, normally we see a correlation with equities. This time around, we actually haven't seen that. Our equities, if we look at what we're looking at here, we've got custom domestic SA index. So what we do is, what I'm looking at on the blue line is the domestic SA index. So we take out all the mining companies, the foreign dual-listed companies, and we're focusing really just on the local focused companies. So mostly banks, retailers, insurers, and industrials. And you can see that relative to history, they're trading quite cheap. And they tend to price off the bond yield generally because that's your risk-free rate in your cost of equity. And this time around, we haven't seen that follow through. So our equities are still cheap, even though our bonds have strengthened quite a lot. And we think that's quite a dislocation. One of it needs to move the other way, and we think it's likely that equities need to move higher. And then, of course, we know that if we look at our domestic SA market versus the global emerging markets as well as developed markets and the MSCI world, we are trading cheap, and we still trade at quite a discount to our peer markets. So just looking at the theme of electrification, we've obviously heard about the hype around, AI, etc. So important to point out, we're not making a call on whether the AI, all the capex that we're seeing being spent or announced will translate into real benefits down the line, as well as whether we are in an AI bubble or not. We have seen the AI capex numbers pick up from all the major companies, and the slide I'm showing you really is just all the major companies, the hyperscalers, Amazon, Microsoft, Google, Meta, Oracle as proxies, how in the last couple of years and the projections for the next 3 to 5 years, they're spending multiples of what they spent historically. So cumulatively, they'll be spending nearly $500 billion per annum on capex. And again, we're not pointing out whether there'll be real benefits or not, but that capex will be spent. And where a big chunk of where the capex goes is actually into AI and data centers. Now, AI-related data centers are highly energy intensive. The chips that get used in those data centers and servers are highly energy intensive, and they could use up to 4 times what a normal AI server takes in terms of power consumption. And the demand from data centers is expected to double in the US in the next couple of years, given all this capex that we're seeing. And that takes the overall data center consumption as a percent of total US consumption from about 2.5% to 7.5% in the next few years. Now you're adding all this demand onto an already constrained grid, and the US grid is extremely constrained, not only in the US, around the world. When most of the grid is aged, and you're adding a lot of more power demands onto that grid, and the net result is you need to spend on the grid, and you also need to spend on this AI data centers. Now we've got several companies that we've invested in that benefits from the electrification part of the global theme of the capex spend, and those are Quanta, which is an electrical contractor, and they've got high market shares in transmission as well as build out of electrical contracting in the US, and they stand to benefit quite strongly as the larger players tend to partner with the larger contractors. They've got high market shares, and they've done well. And then GE Vernova is another company. They spun out of GE, and they do sort of the gas turbines and power generation is what they do. So they've got their backlogs on both of these companies have grown very strongly. And we continue to benefit. We held these names in our fund, and they've done well for us, and we continue to see a good outlook for them. Then the other part of the equation with the spend, I think you've gone through, is at the end of the day, copper demand, because you need huge amounts of copper. So the copper is the one metal that we're very bullish on going forward. So if I just look at North American copper demand, going back historically, you've had a period of where production was an deindustrialization in the US, where things were outsourced to the East, to China. That we went through a few decades of that, and then a couple of decades where demand was fairly stable, as that had stabilized. But I think where we are now, you've got the AI demand on the one hand, and then you've also got reshoring. So we know a lot of this, the reshoring may not happen, but there is a big chunk of reshoring that will take place with global corporations re-establishing production capabilities in the US, and that's expected to increase copper demand. And there we've got exposure via Anglo American and Glencore. Now, Anglo American, with the recently announced tech deal, will increase their copper exposure to about 70%, and that's high quality copper. They've spent the capex, and that production is coming online. And then Glencore is about 40% exposure to copper. So domestically, that's how we're playing some of that theme, where we think copper is from a supply and demand perspective well positioned. So overall, from an electrifying equity theme in our portfolio, these are some of the names that we've got. I mentioned Quanta, GE Vernova, Broadcom is really on the chip side. Siemens, the global, the German industrial conglomerate, also expected to benefit in Europe. And then from a copper demand perspective, Anglo American and Glencore. Those are the names and some how we position the portfolio to benefit from some of the theme of electrification. So just looking at the fund positioning, the fund is well diversified, and we're very bullish on financials, particularly SA banks, some of the SA insurers, and then some of the global banks as well. We've complemented some of those names in there. That's nearly a quarter of the portfolio. And then materials, another quarter of the portfolio, and that's largely diversified miners, gold and platinum companies. And then consumer discretionary, another 20%. And then some staple exposure, which we think the staples that have derated quite a lot, with the exception of tobacco. And those are, from a long-term perspective, offering a lot of value at current levels. And we've been adding to some of those names, particularly in the beverage space. So from a SA stock perspective, then the way we break up the themes or the buckets in our domestic market, we've got our global non-resource lineages. So we're still very bullish on Naspers and Prosus, and that's largely we still think Tencent is a high quality company that will benefit from AI in China, and they've got a $1.4 billion user base within WeChat, and that's their messaging super app. We think that outside of Tencent, the Rump assets outside of Tencent, predominantly food retailing and classifieds, have turned free cash flow positive. And we expect that the discount will narrow and the market will start assigning value on those assets in the next few years. So we expect further narrowing of the discount. AB InBev, we think that, there are headwinds to global beverage consumption, but we think that the free cash flow generation is very high and the company is de-gearing with that cash generation. So the outlook still looks good and valuation is attractive. And then those are some of the other names. Then I think where we're very excited domestically is really on the SA Inc. side, and we've got exposure there via the financials as well as some of the consumer and industrial names. So particularly on the financial side, the banks, we think they're exceptionally attractive from a valuation perspective, and you underpinned by very high dividend yields. So you get paid while you wait, with dividend yields of about 6 to nearly 10% on some of the names. And then on the insurer side, Momentum, we've done very well. We continue to hold on to our Momentum position. And then domestically, some of the retailers and consumer discretionary names and industrial companies. And then from the resource perspective, I've spoken about Anglo American and Glencore. We've also, our preferred names in gold is Anglo Gold, and then Impala Platinum on the PGM side. Some of the names that we've complemented the portfolio from a global high conviction positions. From a technology perspective, we've gotten with the names that we feel we've got more conviction on a long-term earnings delivery perspective, as well as where we feel the valuations are not excessive. And those are Microsoft, Broadcom, and Meta. From a consumer side, we've got exposure to Arca Continental, which is a Mexican and American Coke bottler. So we don't have direct exposure to Coke bottlers or soft beverages in South Africa. So that complements the portfolio. And then EssilorLuxottica, the sunglass manufacturer, the owner of Ray-Bans, they have partnered recently with Meta and smart glasses, etc. That's going to be quite a big driver going forward. And then from a pharma perspective, we don't have direct pharma other than a generic pharma locally. So we've complemented the portfolio with the likes of AstraZeneca. They've got a good oncology portfolio. Eli Lilly from a GLP-1 perspective, and then United Healthcare from healthcare in the US. And then I mentioned the likes of GE, Vernova, and Quanta, again, part of the electrification theme that we see going forward. And Shell from an oil perspective, as well as Siemens, which also benefits from electrification in Europe. And that's overall how we position the portfolio and some of the opportunities that we're excited about, and we're looking forward to continue adding alpha for our clients. Thank you.